We've been talking about CTV all day. We're talking about it all day, but don't necessarily expect at this point, at least not yet, that everyone's going to reallocate their entire TV budget to CTV. So the good part is streaming and linear TV work really well together. In November, Comcast even found that 57% of reach achieved of streaming was incremental. I think Chris mentioned this earlier. This dynamic duo is the theme of our last panel. Jeff Minsky, editor and lead analyst at Mediavillage, friend, former client, and neighbor of mine as well, is moderating this insightful discussion about incremental reach.
I missed you at ShopRite last week. That's all.
And what it means for your audience-based buying strategies. Closing out Innovating with Intent. Here is Greg Joseph, Senior Director of Demand Partnerships of Freewheel, and Jason Wiese. I hope I got that right.
Got it.
Close? Good.
Thank you.
SVP Director of Strategic Insights at the VAB. Take it away.
Thank you, Ross. Thank you for for having me avoid having to say Jason's name incorrectly. So, first of all, thank you all for coming today. And as the last panel of the day, we do know it's Cinco de Mayo, and so we're keeping that in the back of our minds. We'll get you out of here as soon as we can. And especially since the market dropped 1,000 points, I think we could all use that drink today. So we're here to talk about what, in effect, is what Bob Garfield from Ad Age, our ex-Ad Age guy, used to call the chaos theory. Just because one model is twilighting doesn't mean exactly that another model is completely ready to take its place. And I think we are well beyond where we were 5-10 years ago. There's no question about that. We've made a lot of progress. So we're not at the beginning of the chaos theory. I think we're more closer to the end of the chaos theory. But just to start off and level set, let's define video for this conversation.
Cool. So, so we've done some research around this. So I'll take it from the consumer perspective. That in terms of, and we heard earlier today that TV is TV. So, we asked in terms of consumers, we asked what do they consider TV, and this goes into the whole video where we saw that 45% of consumers said that TV is anything that they're watching on TV, whether it's linear TV or whether it's streaming. And then there was another 25% that said anything that they're watching on any sort of device is TV. So, you kind of see the connection of the TV and the video. And what's kind of interesting when we asked them about TV, one of the most traditional kind of definitions of TV, I define TV as content that a TV network puts out. Only 13% of people said that. And, when we kind of looked at the differences between demographics on that, that was the same percentage across all sort of demographics. So when we looked at sort of, obviously people are thinking that TV and video, it's really cross-platform, it's very multi-platform. And then when you kind of look at the segmentation of that, you see that it really didn't change that much either. And that was kind of also an interesting thing that when we look at streaming, and you look at streaming consumption, it really does mirror the population. And one of my kind of consumption facts that I really kind of like to kind of like dig into is the idea that adults 50 plus collectively spend more time streaming than adults 18 to 34. I just find that always so interesting. And that's also the function of just it's a large audience. But where we talked about streaming 5 years ago, where that was a very heavy 18 to 34-year-old composition, now it's across the board.
Let me ask you a question. Is that a bit of pandemic-driven? I mean, because we heard a lot about that as the pandemic was going on. In the heart of it was that all of a sudden this new age group was starting to really adopt the idea of streaming.
So absolutely. So that was going to happen eventually, but it's one of those trends that happened during the pandemic that was accelerated. So when we looked back at consumer expenditures for the adult 50 plus audience in 2020, they spent $1,200 on consumer technology for home versus what they spent the year before, $300. They were upgrading their equipment. They were upgrading their TV to a smart TV. They also have there's a lot of time being spent at home, obviously during the pandemic, so they could spend a lot of time watching content. They were also multi-generational homes were kind of living together a lot of times too. So adults 50 plus, they were learning from their kids about how to use these tools.
So if you narrowly define TV, most of us would say it's just a big screen in your home, and I think historically that's what we've deemed it to be. I think more recently, specifically over the last few years, to your point, TV, the way Freewheel defines it now, the way we're thinking about defining it is essentially where the audience is. If Jeff is watching an ESPN game on his phone, it's no different than Jeff watching on TV. That the person is still the same. So I think part of what we have to think about as we're thinking about TV is the evolution of the device, and the device not necessarily needing to be a big screen in someone's home.
So I'm going to challenge that a little bit for a second, and not to be overly challenging, but there was a research study from the Journal of Advertising Research back in September 20-something, like early on, that showed that the impact of a commercial was greater the larger the screen. Now, there's an interesting dynamic that's gone on over the past few years. It's sort of a dichotomy. You have, obviously, mobile. There's no question the proliferation of viewership of video on mobile is exponentially increased. At the same time, the average size of the television at home has gotten tremendously big, which is why I laugh when everyone says television is dead. If you look at the Consumer Tech Association's reports year over year, there has not been a decline in television sales, and those televisions have only gotten larger. So the question, I guess, is there some sort of factor that a media buyer needs to take into account in looking at the distribution, if in fact there is an impact? I agree with you, viewership is viewership. There's at a base level. But when you start to look at, there might be more of an impact on a large screen versus a smaller screen. Do you think, and again, I know there probably isn't any research on that from that perspective, but your gut feel.
To chime in on that, I think sometimes what happens is you bundle all the data together. So when people say that there's not a significant impact, you're including YouTube, you're including a lot of short-form content, which I think collectively agree short-form content is completely different than long-form content. When I'm watching This Is Us on NBC, that's a completely different experience.
I cried last night, please, let's not. No.
It's a completely different experience than watching cat videos on YouTube. So that needs to be separated.
I cried at that too, though. So.
And then the data makes a lot more sense. And then we start realizing that long-form content, no matter where you view it, has a significant impact.
Let's talk about the type of content now for a second. You talked about long form versus short form, but also the proliferation. One of the interesting things, and just for background, I ran emerging media and innovation at Omnicom Media Group for 15 years, and the last part of it was spent on the advanced television world. And one of the things that we were most excited about when advanced TV and things like Roku started to come out was this idea of more content for the diversity of the population of this country. Have you started to see that viewership? Have you started to see some scale? Obviously, it's not going to get to the scale of a Hulu or a Peacock or a Disney Plus. But have you started to see any kind of viewership habits change in watching some of these things? Because you go on a Roku and I used to joke there are like 300 gospel apps on there or something. But things like that.
Sure, I'll take that. Okay. And if we can actually jump back to the factors after this, that'd be great, because I'd love to be able to touch on that too.
Absolutely.
But in terms of the diversity of content, I mean, that's something that streaming pays off very well. And we've done research around multicultural audiences, Hispanic and Asian American specifically, that they are streaming to get that in-language content as well. So it's. Obviously it's across the board. Linear TV, they have hundreds of channels. You can find that. It's just streaming has really been kind of a powerful force in that, and to get not just in language, but also very culturally relevant programming out there. So, when we look at, what are kind of like the kind of ahas that we see on the streaming world in terms of demographics, it's the 50 plus, and it is very multicultural.
Yeah, and to that point, the one thing I'd add is if you think about a lot of these smaller apps, and I think about Afroland TV, I think about Telemundo, which is part of NBC, Univision, we're starting to see a lot of adoption with those small apps as well. So I think as the industry continues to evolve, we'll continue to see streaming uptick on other platforms as well.
Form factor.
Yeah, I wanted to go back to the factors because it's very interesting. We're working a lot on this, actually. And this is one of our big things that we're going to be tackling over the next couple of years at the VAB in terms of quantifying quality impressions. And it's tricky. It's a challenging question. You mentioned JAR had some research out there. We know that Karen Nelson Field out in Australia has done stuff on that. It's a very, very tricky question because when you look at content, if you try to do ad effectiveness against content, that can be a little squishy because that's subjective. So that can be very subjective. A premium content could be, it's one person's junk versus another person's treasure. I might like something, I find something engaging, and then somebody else might be, okay, I don't know. And that also plays against demographics. But what we're going to be trying to do is that we have 8 non-subjective factors that we're going to be looking at and trying to put some sort of factor against it and trying to learn a little bit more about that. And what are those? Those are screen size. Those are ad size, that's screen coverage, that's ad duration, that's content duration, that's brand safety, content environment, which is a little bit different than what I was talking about content type. Content environment's a little bit different. So this is stuff that we're going to be tackling. And I've noticed that the same research too, that the bigger the screen size, the more attentiveness it is. Sure. The more coverage, the more attentiveness is. So that's something that we're going to be really getting into.
Well, I wouldn't be me if I didn't put in a shout out to virtual reality and the fact that VR headsets are also starting to proliferate. Not at I don't want to oversell the speed that they're out there, but one of the use cases that is surprising to many people is it's not just about gaming and Beat Saber and that. It's about viewing, especially for younger demographics that are in an apartment. And now instead of having to buy a TV and argue over what your roommates are going to watch, you're viewing on an IMAX-sized screen in your bedroom, all the content. So again, screen size may be virtual and or real. I want to switch for a second now as we start to talk about the upfront and what's going on in the next few weeks. But the IAB this week released some forecasts, basically said that the streaming video numbers were up to about $39 billion in revenue, which was up 49%, and will be up 26% this year to $49 billion. And I guess now what we're starting to see is this holistic approach to the upfront. Yep. And that's been going on it's not new, it's been going on for the past few years. But the question, I guess, is, where are we? Where do you see it headed this year in particular? And given, in the early days, and I'm a little bit removed, so in the early days it was, okay, we have no problem moving money from traditional linear into CTV and OTT or streaming if it's like-to-like content. Now, you mentioned before one person's trash is somebody else's treasure. But in fact, there is this concept of premium inventory starts if someone's putting a real investment in production value, in storyline, in talent, that there is some reward for that and there is some greater impact if you're associated with that. Is that the case? Or is it, if someone really loves cat videos, is it the same value? And should the dollars start to move a little bit more flexibly from linear into CTV and others?
So as it exists today, Freewheel works with 90% of the programmers/broadcasters in the US, and I think 80% in Europe. One of the things that we've seen is for every upfront now, CTV is part of the conversation, and it has to be part of the conversation. The one thing that's been happening over the last 2 years is now programmatic is part of that conversation as well for the execution of CTV, and primarily programmatic guaranteed, which hopefully most of you guys are familiar with, is this notion of being able to understand audience for these guaranteed buys. Historically, agencies and advertisers haven't been able to do. So it is going to continue being part of that, and PG and various guild types will start coming into play via programmatic pipes, at least my view of the future over the next year or two.
Yeah, so, going back to the whole quality, professionally made long-form content, obviously totally believe that it drives results, and we like to always use the example of direct-to-consumer category, and the fact that direct-to-consumer category has been around 10 to 12 years or so. They were heavy social media. Obviously, they're digital native, heavy social media, heavy search. They started going into TV. And I'll extend that to CTV as well. But they started going into TV probably about 6-7 years ago. 5 years ago, collectively as a category, they were spending $1 billion. They are now spending $5 billion in TV. I don't have the CTV number because there's not a good aggregator of CTV dollars out there from independent, but they went from $1 billion to $5 billion. They went from 50 companies to 350 companies advertising in TV. And you're talking about direct-to-consumer brands who they know everything about their business. They are performance-based. They know everything about their customer, and they are double, tripling, quadrupling, 5 times down on TV. So we always use that example as the long-form engagement of TV, and again, by extension, CTV works because we can just look at DTC companies.
So is this also about incremental reach? I mean, that's the term when we talk about the upfront. I keep on hearing everyone saying, okay, the sell is incremental reach. Mm-hmm. Is that the sell? Is that where everyone is at?
Yes, essentially, yes. You get to better understand audience. Historically, for upfronts, it was very hard for agencies and advertisers to understand what audience they're hitting. In this world of digital, whether it's CTV or even a cable box, which we make available to our partners programmatically now, you get to understand audience and what the overlap is. And how do I reach audiences that I'm not reaching on linear? And it's something that we've done very well with Freewheel, which is one of the companies under the Comcast umbrella. But it's something that needs to continue to evolve because as you're thinking about incremental reach, there's fragmentation that exists and there's so many different apps that users are chilling on. It's like, how do you reach all of your audience, which is more and more becoming something that we're thinking about, and specifically with the evolution of the industry.
And part of it also is this idea that television being historically, and this really does go back to the core of it, is that you're still talking about this period of time where you have one to many versus one to a few, let's call it that way, because it's still not one to one necessarily in the CTV space. The past year we've seen, well, the past 3 decades we've been complaining about a certain monolithic currency that has been out there. But in particular over the past year, there has been a lot of real challenges to the legacy currency. Do we see that this upfront there will be changes? Do you believe that part of that, again, being driven by the real results you see from a connected TV campaign, that there's no longer the acquiescence of I just want to know about GRPs? And certainly the challenges and obviously the MRC issues that Nielsen has had. Where do you see currency happening? And I know the VAB has been really on the forefront of that, but I'd love to hear both opinions.
Yep.
So I'll start.
Okay.
I actually want to build first off of Greg's point about incremental reach and about the GRPs and whatnot. And it all starts with the incremental reach. And one of the oldest media theories out there is, the more reach you get, the more sales you get. So, the incremental reach is just the starting point because from there it cascades throughout the funnel. You get higher reach, you get more engagement, you get more people coming through your storefront, whether it's your digital storefront or whether it's your foot traffic in your store, and you ultimately get sales. So, it kind of all works together with the incremental reach starting point. So, talking about going into this upfront, what's the big thing that's going to be about this upfront? It's going to be about measurement. It's going to be about alternative measurement, alternative currency. And, you mentioned, Jeff, about the VAB work, and I'm not sure if anybody, how many people know about the VAB work, but, we did a lot of work around looking at the deficiencies of the Nielsen panel during COVID. And, what we found was that they suspended their maintenance for their panel during COVID. That didn't result in good outcomes there. And we understand that panel's very expensive to continue to upkeep and whatnot. But when you look, when we started looking at the panel because as we were going through COVID, we saw that there were things that were just not passing the common sense rule. TUT levels were going down. TUT is total use of TV. That means you're doing anything on a TV. You're watching TV, you're watching streaming, you're doing anything on a TV. And we started seeing that second month, third month, fourth month, fifth month of COVID, that those numbers were going down. That's not common sense. Everyone was home. There's nothing else to do. So that was what we when we saw that going down, we were like, okay, what is happening? How is that? This is not common sense. So we started looking at the panel, and we looked at the panel, and we started seeing, since they didn't maintenance their panel lost 20% of their people, of their respondents. Outside of that, or within the leftover, so you went from 40,000 to 30,000 panelists. Within that, you lost a third because there were just people not doing anything. They were just, and I say that, I mean, their equipment might have been broken. Yeah. Like they couldn't hit a button. So they were there, but it just was not working correctly. So you went from 40,000 panel to 20,000 panel, and that just screwed up the ratings. To the point where MRC put an adjustment factor of 1 to 6% off the on the ratings. So, our thing is always, we want every impression to be counted across every device for every piece of content. I think that's very fair. I don't think anybody would want to argue about that. So, we're going to the first upfront in decades where there's been no TV company that has MRC accreditation. So it's really opened the door to consider other alternatives, alternative measurements. Beyond the panel. So there definitely is a place for panels. But there's, let's think about when the panel was made for 40,000 people, or 40,000 homes, decades ago, going back to, say, when we were talking about 5 networks and 50 cable networks. Right. Okay, we are so audience fragmented right now, and we're still talking about a panel as the only piece. Now, that's going to change with Nielsen 1 coming out, being rolled out in December, but that's going to fuse the panel to the big data that they have about the 40 million homes. So it's not just about, this is a linear TV issue because we're talking about a panel. No, the panel actually feeds the CTV, the streaming side, and it's going to fuse in with the big data. So this is something that has to be solved.
Are we, and Greg, that might be closer to the conversations that you're having, are we almost done with GRP upfronts? Is it impression-based? Is that where we're at?
Yes and no. I think the problem that we run into in the industry is the buy side and the sell side need to agree on a lot of different things. There continues to be a lot of friction that exists because one person wants one thing one way, another person wants things another way. And I think until there's not conflict that exists as far as what do they view as measurement, what do they view as the best way to do things, we're going to continue seeing not a real way to kind of leverage audience and insights, which historically has always been a problem because you didn't have the data that you needed from Nielsen, which you know all too well about.
Well, I just want to dig in a little bit more because you said before that programmatic will be a bigger part of the upfront this year. So given that background that you just said, how will they execute and get to a like-to-like comparison to allow fluidity in the media buys?
So impression will be a big part of it. One of the things that programmatic allows for is insights into who your users are and who's actually how buyers are reaching their audience. So if you think about a P&G who's a big advertiser, they care a lot about their first-party data and reaching their specific audience. As the upfront moves to programmatic pipes, we allow for that visibility, and then the measurement becomes, or the currency becomes impressions. But when you think about an upfront, that's a $500 million deal, and what's being facilitated programmatically is probably $100 million. So once we start seeing a larger chunk of these upfront budgets transitioning to programmatic pipes, then you have consistency on what currency is being used. But for now, the smaller portion, impression-based, larger portion, still leveraging Nielsen for the most part.
And we talk about CTV, we're talking about a digitally delivered ad. That digitally delivered ad does not have to be a 15-30 passive ad. There can be interactivity, there can be feedback, there can be targeting, there can be dynamic creative. Where are we in the level of sophistication that marketers and how should pharma in particular, especially with all the guidance that they have to give and all the caveats that have to be on the ad, do we see any kind of opportunity here to kind of evolve that a little bit?
I'll take this one. One of the things that we've seen specifically as CTV has evolved is more inventories opening up for pharma. I know one of the things people like to say is that 6-second ads are great. 6 seconds of ads are great for short form content, but not really great in a CTV world, especially for pharma that has a ton of regulatory laws around that where you need to have a ton of information in an ad. As more inventory opens up from the NBCs of the world, the CBSs, the Warner Medias of the world, that allows for pharma to be much more successful because you now have 30-second slots, 2-minute slots, which historically hasn't been available programmatically because CTV wasn't where it needed to be over the last few years.
And I'll just add on to that in terms, I think when we talk about pharma with CTV programmatic, I think one of the great examples is the targeting aspect and the precision targeting of very niche audiences, potentially. We did a piece called Stream On last year about case studies. We had 23 case studies across 15 categories. We had a couple of deep intent case studies within that. And, think about a pharma case study or pharma campaign, that it could be a very targeted audience against somebody that has a very specific medical condition. And that is such a precision target that you don't know if you're reaching them in linear TV. You probably are maybe, but you don't really know any of you don't know if you are, in terms of what you're doing with CTV programmatic, you can find that person, you can optimize against that. And with the case studies, we saw, or Deep Intent saw, that as their campaigns went on and they optimized, that they were getting 4 to 6 times reach against their target than they did before they optimized.
Where do you think we're headed in the next 12 months? We've got the upfront coming, and we've talked about that. But there's been a lot of, and I'm not joking now. The economic conditions of the country, the volatility, and everything that's gone on is going to put intense pressure for more ROI. And the marketplaces are, at least from my putting feelers out to my contacts. Whereas maybe a month ago, clients weren't overly concerned, now there's a question at how robust this upfront will be. So where do you think the next 6 to 12 months are going to take us?
Take that one first.
Sure. Yeah. So, it is. I mean, as the months go by, you just see the consumer confidence decrease even more. It'll be interesting because there is that trepidation out there in terms of what's going on. This isn't our first rodeo in society in terms of economic downturns. I say until I'm blue in the face, the best time to advertise is when we have these times. It's the most efficient way to gain share of voice, and gaining share of voice is how you gain share of market. And I'm going to roll that into ad-supported streaming. There's going to be opportunities out there for brands to get good share of voice by doing convergent TV, by doing linear TV, by doing streaming. And, I come back to years ago, people were saying TV is dead. Obviously, we all heard that. Don't forget, 2 years ago, people were saying advertising was dead. We were going into COVID. Everyone was getting subscription services. TV, where are you going to get people? Where are you going to get advertising? Nobody's going to have advertising. Again, it comes back to COVID. You had nothing else to spend your money on, so let me do subscriptions. But that wasn't a sustainable model. And I think a lot of people figured that what was going on 2 years ago was just going to continue going on. Just as much as there's an acceleration, there was going to be a deceleration. And consumer behavior, nothing beats the economics of free. Nothing beats the economics of free and low cost, especially during an economic downturn. But even in normal society, when the quality is pretty much the same, if you're going to pay for it, you're going to have free. People love free stuff.
So let me actually delve into that for a second, and I want to get to you.
Of course.
But people love free. So you've got free ad-supported television. These, Vizio, Samsung, LG, all basically mimicking your cable networks.
Yep.
You have historically, we've seen in economic downturns, cord cutting accelerate. That's just it's a monetary decision. We now see a gig per second society. We already see that numerous ISPs and providers are trying to even push people to get the gig per second and maybe kind of twilight the old cable world. Not immediately, I'm looking because I don't want to offend Comcast, but at the same time, it's happening. And so if you've got your gig per second and you have your free ad-supported television, is that a new area that pharma should be looking very closely at? Or is it really now that we have our mindset switched so much to on-demand? I think it was the Freewheel study that said that, was it 48% of streaming is ad-supported, 52 isn't, or the other vice versa?
Yes, 52 isn't.
Yeah, 50, right? So, that's one of the interesting things I've been looking at over the years, is that everyone's talking about linear deprecation and the ratings going down, but streaming services have been not, for the most part, low ad weight or no ad weight.
Yep.
We do have Netflix. We do have Fast. Netflix will be offering the ad tier. I guess hell did freeze over for Reed Hastings. And Disney Plus has their ad tier coming out. So where do you see that part of the landscape, and where's the opportunity for pharma in that and the live fast streaming?
I'll start. Can I actually take a contrarian view on something?
Please.
It's late in the afternoon. Might as well hit it, right? So,
I hope there's tequila later, but go on. Yes, so.
yeah.
Okay, good. All right, good.
In terms of paid TV, obviously in the past with economic downturns, we've seen acceleration of cord cutting. I'm not quite sure we're going to see that this time around. And there's going to be a couple reasons why I'm going to say that. We have about 65 to 70 million homes right now that have paid TV. Probably around 66, 68 is probably the actual number. That's down from about 100, 105 10 years ago or so. A couple of things playing here. A lot of people that were going to cut the cord already cut the cord. And I think when we think about this economic downturn, specifically what's going on here with gas and energy pricing being so expensive, a night at home with your pay TV with 100 channels is a pretty efficient night to spend. So that's not to say, we know what the trends are. We know that the trends will continue going down for cord cutting. Many of us believe that there's a floor for pay TV. That's probably going to be about 50 to 55 million, that these people are going to have pay TV no matter whatever happens. So I think it'll continue. There will be regression on the amounts. I don't know if it's going to accelerate.
But has content, and I'm specifically talking about entertainment and information content, not necessarily social or other things, but is content, given the fact that we now live in a world where content never dies. The top two shows on Netflix and Hulu or whatever was The Office and Friends, and now they're all wherever they've been reallocated to. But the point is, these are shows that were on 20 years ago. And so does that mean that because of the laws of supply and demand, that the subsidy that advertising for attention should be moving more away from the idea of content to some other types of services? Something, for example, that we've seen the rise of retail media. And so that subsidy becomes stronger there. To my point is, I agree with you, there's a floor, because there is a generational issue of pay TV as well. But as we start to adapt 5G for the home, and gig per second downloads, does that whole concept of the bundle really become bundled OTT plays and CTV plays versus what we traditionally called cable?
Yeah, I think absolutely it would be bundled, and it can be bundled by the OMEs, or it can be bundled by the cable companies too. And when you look at the content, you see content flowing interchangeably. You're seeing that, obviously we know that Dancing with the Stars is going from ABC to Disney Plus, presumably when Disney Plus launches their ad-supported tier. But you're also seeing Flight Attendant from HBO Max going to TBS and stuff. So you're seeing, to us, it's a convergent TV. Content goes back and forth, just like consumers go back and forth. Personally, as a huge sports fan, I can't wait for 5G to come, because the latency issue on streaming sports should get better, hopefully, because that's another story. I'll keep my sports betting to the side for that one. But
a strong category that will keep the media economy going, by the way. So.
Yeah, I'll keep my degeneracy out of this. But anyways, the convergency goes both ways, both with the content, both with the upgrade of 5G and both devices and everything.
Right.
I think content will continue to be important for a lot of different reasons. Most of us, while we use free ad-supported apps that may exist, they're not readily used. So if you look at the biggest apps that exist today, they're generally Peacock, Disney Plus, HBO Max, and several others, but they're generally not these like free ad-supported ones, because content is extremely important to all of us. Like as much as we like The Office, which most of us do, there are other shows that we love as well. We love This Is Us. We love all these new shows that constantly get released, and that's why Disney Plus has grown so significantly. One of the things I think which will happen specifically over the next year and a half is we're going to continue seeing scale for a lot of these apps that weren't ad-supported, Disney Plus being one, and Netflix being another. We're going to start seeing opportunities opening up for agencies and advertisers to tap into. And we're going to start seeing CTV evolve a lot. CTV may not look the same way in the next 2 years. And I think for us, as we're thinking about the evolution of the industry, is like, how do all these pieces start working together and make it more meaningful for the user? Because more and more, when we have these conversations with any one of our publishers, the first thing they bring up is user experience. How do we make certain that the user experience remains the same despite additional ads being seen, which Netflix is going to obviously have to deal with over the course of this year? But the user experience piece is the one that still needs to be figured out, is how do you maintain that while making certain that you can still make money off some of these ads?
Well, I think that's a good place to kind of wrap up, because I think if we look at it, we know that what the next 6 to 12 months means is there's going to be a lot of discovery, a lot of innovation, a lot of trial and error, a lot of testing. But more importantly, the role of programmatic and automation and dynamic creative, I just see increasing and becoming much more important. So first of all, I wanted to open up with this. I forgot to open up with this. Your two companies, especially in the 15 years that I was at Omnicom and leading the charge on innovation and emerging media, the reports that your companies put out were so incredibly vital and critical to this industry being established and moving forward. So thank you on behalf of the buy side. But thank you for coming today. Were there any questions before we wrap?
Yes.
Oh, of course there is. Jacob?
Curious, there's a ton of excitement around CTV, household addressables. And maybe on the Freewheel side, you may be able to comment because you own Comcast. Where is addressable cable? Think about the linear market, and it has the same household addressability that CTV. I haven't heard the same buzz. It's separate conversations. Do you see, where do you guys think the convergence is? Because that's the same sort of data-driven targeting, supporting. Where does that merge with CTV?
Very, very good question. One of the things that we've come to learn, similar to pharma, there's a ton of regulations around household information. If you think about a lot of these legacy cable companies, Comcast being one, there's sensitivity around sharing household information with agencies and advertisers, something we're trying to get around. But nonetheless, it becomes very similar to CTV, because if you have a cable box that's connected to the internet, which most of us do now, that can be leveraged programmatically. So a lot of what Freewheel does today is across cable boxes programmatically, and we have a lot of DSPs that speak to us saying, is there really a difference? Because what's being served on the CTV and what's being served on the cable box are essentially the same. The TV screen is the same, it's just different devices that are being used to actually input the ad onto the screen. Go ahead.
What is the penetration now of the cable box that can actually be addressable? Because there's a lot of them that are just not supported.
So it's over 50%. The one limitation that exists is IP and the usage of IP. A lot of cable providers obfuscate IPs, and when IPs are obfuscated, they mean nothing to most of the buy side. So one of the things that we're working through is how do we add data and insights into bid requests we're sending out to DSPs to make it usable for agencies and advertisers bidding through these platforms.
Good questions?
Any additional questions?
Yes, Mark?
So first off, Jeff, I agree with what you said about the reports from both the VAB and from Comcast. I'm very familiar with both for a long time, so they've always been terrific. A lot of what I heard in this conversation, okay, really to me sounded like a discussion around value versus commodity thinking, okay, especially you, Jason, what you were pointing out, okay? large screen versus small screen, long form versus short form. I was thinking limited commercial load versus full
we're
load.
looking at, sure, yeah.
Environment versus whatever, lack of.
Yep.
Incremental reach versus duplication, okay? You put all that together, plus probably all the data, the targeting versus the lack of, put it all together, it's a pretty robust package on the quality side versus the whole commodity side, okay? Is there any room left in the business for media companies to really go out and make a strong argument for quality and to be rewarded on price for having the quality deliverables? Or is the market just so fast moving, there's so much technology, there's so much inventory out there that it's, in a way, there's just a big price war going downward? I mean, can somebody still stand out with a quality deliverable and earn the price for it?
Yeah, so I would also challenge that there's so much inventory out there, that there's still limited inventory out there, and there's more advertisers looking to get into TV, looking to get into CTV than they are. So when you look at the upfront, and that's one of the challenges sometimes of when brands leave TV or brands move from TV, those are fairly easily replaceable with other brands, especially with DTC companies. So it's always about chasing the premium pricing too. So quality continues to be a big factor within that, and trying to think where else I can go with this one.
Well, you're also seeing a little bit of a realignment because Discovery Warner just pulled all new scripted series off of TBS and TNT. So it's they're moving the scripted onto their OTT platform. There's the quality, and there again, it's going to be very interesting because again, that goes back to what I was saying about the value proposition. Because while yes, you've got people still paying for content or watching commercials and wanting that subsidy, more and more people are saying, well, I'm getting this bundled in. When I get my Verizon, I get Disney Plus for free. If I sign up for my Comcast package for ISP, I would assume you're going to be giving some Peacock into that at some point for free. The ads, whether it's the ad-supported limited ads or the non-ad supported. So I think that dynamic is also changing, and I do think it changes the question of what is premium content, and it changes the idea of, do marketers have to open their minds a little bit more and be a little bit more flexible on their definition of premium versus what they had 5-10 years ago?
And I think your comments on the emerging D2C segment is important because it puts pressure on all the rest of it, right? You get a whole new segment of advertisers rapidly ascending in the market.
Yeah, and they're usually paying a different CPM than a legacy CPG, and so too, because they know where their valuable customers are, and they're paying for it.
I have a question about, you were mentioning about kind of the acceleration and deceleration of the market. Everybody from COVID staying home, huge acceleration, not sustainable, deceleration. Do you think that if Netflix officially announced that they were going to put in ads, which it seems like they're certainly considering given the stock market and all that jazz, and they lost users, as well as Disney Plus coming in with a price-friendly model in the lower range, that we see an actual mid-year acceleration because those two contain such clout that they get a lot of folks that maybe were on the fence of even getting in the first place, but it comes in at a price point that's acceptable for them, which then disrupts the market, adds inventory, and nobody's prepared because it wasn't there to initially begin with.
Can I take that first and then George?
Go ahead.
So, a comment I made when Reed Hastings first made that ad hoc announcement during an earnings call, which his own people had no clue he was going to do. Different a little bit for Disney because they own their content for the most part, or all of it. But I have no clue. In fact, I tend to doubt that Netflix and their license agreements for the content that they have has the right to sell ads against that content currently. At least certainly for a good majority of that.
Yep.
Which means it's going to be another year at least before this ad tier for Netflix comes out, because all those contracts have to be renegotiated for rev share. Add to that Netflix did not say that they are moving to an ad model. They said they will offer a tier for an ad model. So the question is, what percentage of people and who are the people that are going to pay for the ad-supported tier? In my theory, it's going to be people who have financial challenges or lower income, to which we haven't really had a lack of GRPs or impressions to reach those people. It just, again, accentuates how do you reach middle class / affluent households, because they will continue to do the ad-supported model. So that was my 2 cents.
That's cool. No, that was
Good.
great too.
Okay.
And it's also going to be interesting to see how they do their ad model. Are we going to be talking about 15s and 30s? Are we going to be talking about overlays? Are we going to be talking about something that happens during the pause button? Obviously, a lot of these services are thinking about, I don't want to limit my subscriber base. I want to give everybody a choice. Nobody's putting a gun to your head to get the ad model of Netflix. You can continue on. They might raise the price a couple dollars on that, obviously.
Correct.
But it's all about choice, and it's all about maximizing their subscribers. Bill.
I'm dating myself here, and the only constant in this, especially in this industry, is change, right? Those who are old enough to remember when cable started, it was pay us a subscription and you get television with no commercials, and we all know how long that lasted and how that changed because there was a thirst for content. People loved it, they came to it, you needed to supplement the creative and the programming, and the rest is history. Do you ever think in this industry, as everybody's vying for, everybody's talking about first time in the upfronts, and I've been saying this, it's the first time that there's not a television measurement service that has that MRC accreditation. Do you see a move away from GRPs and even CPM models to an ROI attribution model of the right balance of reach and frequency with the DSPs of the world and the data to reach the right reach and frequency, the right exposure as consumers? 5% of consumers are transactional. Everyone else is relational. It's finding that sweet spot of time to hit that person, to create that awareness. I do a lot of learning events, and I try to tell people the definition of advertising. Look it up anywhere and try to find me where it says leads to a closed sale. It doesn't exist. It's not a part. It's definitely part of your marketing strategy, but it's what kicks it off. Advertising is all about promoting your product, your service, creating awareness to get a consumer to be involved in that creative and then take action. Do you see that being the model in this industry?
Well, I'll say 2 quick points. I know we're over, but it's all about ROI. It's all about consumer impact. It's all about sales, and you're going to see a lot of different models. You're going to see a lot of different currencies being pitched out there beyond audiences. And when I say beyond audiences, I mean even audiences of gender and demo. Beyond that, audience-based buying targets, best prospects, attention metrics, traffic metrics, sales metrics. Now, remember, this is all against the guise of not only is Nielsen not MRC accredited, or anybody's MRC accredited, C3 and C7 go away in 2 years. We start from scratch. There's no legacy currency. There's no benchmarking. There's no comparisons. We all start from scratch in that term. So there's that opportunity, Nielsen included. I'm not counting, Nielsen will have Nielsen 1 there too, but you have all these different currency companies that can get into that. So this is a great time to also think about what can I do beyond audience. And I don't even mean GRPs, I mean beyond audience, whether it's GRPs or impressions. But yes, we should be moving to impressions anyways, but what else we can do?
Right. And I think the pendulum has already started to swing back into a hybrid of not just ROI, not just immediate ROI. Because we realized, and a lot of people realized from the early days of programmatic, that went too far. And that they weren't looking at the bigger issue. And look, I looked at 20 years of digital reports that continually told me that contextual relevancy was the largest driver of impact and engagement versus spamming the world. And so I think that we've evolved past that to this hybrid. What I think is also more important is as the types of video, whether it's social video or whether it's long form or whether it's immersive video in a VR environment, we are back to storytelling. The initial programmatic was banners. We were talking about DR response. It was you weren't changing anybody's opinion with a 460 by 60 or a 728 by 90. Now we're back to storytelling, and that really does bring us a little bit back to that model. anyhow, we are way over and there are drinks waiting, so get the hell out of here.
Thanks all.